Hello, everyone. It's Jose Torres again, Interactive Brokers IBKR podcasts. I'm joined with the Chief U.S. Strategist of NDR Research, Ned Davis Research, and that is Ed Clissold. Once again, welcome, Ed. Happy to have you here.
Thanks for having me back. Looking forward to chatting again.
So it's May 1st, and stocks are off to their eighth consecutive gain, eighth day in a row of gains. But before we get into that, I know you have a lot of insightful things to say about equities. Tell us a little bit about NDR research, what you do, what you guys do, and where can folks learn more about your offerings?
So, probably the easiest way to do that is we have an email set up for Interactive Brokers. It's just ib@ndr.com. That's ib@ndr.com. Email there and we can get you some more information. Also, of course, we have our website at ndr.com. That's ndr.com. You can look us up there as well.
And what kind of stuff are you providing? I know, but for the listeners, what's your recent topics? What kind of research angles have you been providing in the group? What are some exciting things that have been happening at NDR lately?
We cover the main asset classes and not only in the US, but globally. So you're looking at stocks, bonds, cash. Within equities, we focus on style boxes, sector work, and also thematic opportunities. So anything that doesn't necessarily fit into the neat sector lineup, some ideas as well. And then we cover fixed income in detail and currencies as well as global economics. And I think what a lot of people like about NDR is we're very data oriented. Of course, everybody says they're data oriented. Nobody's going to come in there and say, well, they just wing it. But really for us, it's all about our data and our process. And we're following that process. So if you want like an objective view that isn't somebody's opinion, it's preconceived notion about any of those asset classes, that's where NDR can come in.
So great, Ed. Now, 8 days in a row of gains. The S&P was almost in a bear market. Actually, effectively was in a bear market for maybe 5 minutes or less or whatever when went down to roughly 48.30 or something like that. But now we're up in the mid 56s. What are you telling your readers, your listeners? How are you thinking about the state of the markets these days?
Yeah. So I think this is a really good example of the NDR approach. And so when the markets get into a downtrend, they tend to go through a four-step bottoming process. And we'll talk about here, this is mostly technical sentiment driven. And we can talk about the macro and the fundamental here and how things look a little bigger picture in a minute. But for right now, look, the four steps are oversold, rally, retest, and then breath thrust. Clearly, the market got incredibly oversold. Probably the easiest stat to remember is that the 2 days after Trump's Liberation Day announcement, the S&P fell 10.5%. There's only been three other times post-war where the S&P fell 10% in 2 days. That was in October 1987. We all remember that one. November of 2008, so that was right around when Lehman was being liquidated. And then in March of 2020 during the pandemic, and then April 2025. So it tells you just how oversold the market got. We also have the sentiment composite. It has about 25 different sentiment gauges in there, things that probably a lot of our listeners see every day, call ratios, the VIX index, also some polls of individual and institutional investors. So we get 25 of them together. We average them all to give you a number, and it got to the most pessimistic reading on record, tying December 2018. If you remember then, that's when the market was falling apart. Powell was determined not to cut rates. The market was telling him that he needed to, and then he capitulated. But that tells you just how washed out sentiment was. So you got that first thing, that the oversold clearly checked. Now, then over the next few weeks, we got lots of rallies, but they really didn't stick around. And those were not really robust enough for us to say, oh, that was it. Instead, what the market was doing was it was going through that step three, the retest phase. Now, what you want to look for on those retests are signs of less selling pressure. So it doesn't mean the S&P, the Dow, and the NASDAQ, they can actually make new lows, but it's really about things like less volume, less downside volume, fewer stocks falling below their moving averages, fewer stocks making new lows. And so if you go back even just a couple of weeks ago, before we started this run, if you think like last Monday, the market was down 4% intraday. Trump had said he couldn't get rid of Powell soon enough. And then the market rebounded intraday. But from there, we got pretty close to the lows. from on the popular averages, but the breadth was much better. So we said at that point, hey, this looks like a pretty good retest. Now let's keep an eye on step 4, those breadth thrusts. So breadth thrust, a funny term, but it really means is a lot of stocks moving up together. You can measure that in lots of ways. You can have advancing volume, that's all stocks went up in the day. What's their volume versus declining volume? Stocks went down in the day. If that's a really high ratio advancing to declining volume, that's an example. We got that. You also would like to string together, say, 5 days or advances beating declines by a wide margin. We've gotten that. There's another one that people have followed. It's called the Zweig breadth thrust. Marty Zweig, late great pioneer in technical analysis, just looking at advances declines over 10 days. And we got a signal from that where we got a really high number. So we're really starting to stack these things together. Now we have 12 breadth thrust indicators we follow. We've tested it back historically. We really need 5 to say we're in the clear. As of right now, we're sitting at 4. We'll see at the end of the day today if we get a 5th one. It's quite possible. So it looks like we're getting through that bottoming process. But again, we got to let the data speak for itself. But that's how we're looking at things right now.
It seems like getting close to mid-year now and past President Trump's first 100 days, it seems like investors are enthusiastic. We got a GDP report yesterday that was a contraction, but really it was driven by a huge surge in imports that, from my economist lens, points to net exports, so the difference between exports and imports, turning from a significant headwind in the first quarter to actually a pretty sizable tailwind in the second quarter. And when I think about what investors can get excited about, there's so many things: trade agreements, taxation package, milder regulations, continuation of low oil prices. All these things are just can add further fuel to the fire of this rally. I think that's part of the reason why we have 8 days in a row. And then President Trump is also behaving. He calls out Powell, but Bessent and some other cabinet members, maybe Lutnick, sit him down and maybe calm him down a little bit. And the next day he changes his tone. Same thing on trade, really aggressive in the beginning, now more in the middle. It seems like maybe we're at an inflection point and we can have a less bumpy ride from here.
Yeah, I think you hit a lot of really important points there, Jose, and trying to become too much of a guesser what's going on in Trump's head at the moment. It does seem like maybe they've come back from the abyss, which is the thought of we're just going to go full steam ahead, and maybe the markets were telling Trump that's not going to work. And not just the stock market, bond market. It was very unusual. The bond yields were not just rising, but really spiking higher, while other risk assets like stocks were going down. And the administration said their main interest are long-term interest rates, and they weren't achieving their objective. Now, was that part of a master plan to maybe start off asking for a whole lot and then walking back and claiming victory? I'm not going to venture to guess what the long-term plan was, if there was one. But you're right that now we're at a more reasonable point. And in terms of that GDP report, yeah, there was an absolute pull forward on trade. If you look at personal consumption expenditures, which is the main part of the U.S. economy, that contributed 1.2% to GDP growth last quarter, down some from the last few quarters, but still in expansion territory. And if you look like real final sales, domestic purchasers, that's another kind of way to strip out inventories and trade and federal government stuff. That was still solidly positive. Coming into all this, I think the message was the economy was in decent shape. And now we're just going to have to see from here what the negative consequences are. There will be some. Let's not try to sugarcoat it. We're going to get some rough economic data over the next couple of months. It's just reassuring to think that we came into it in decent shape.
Another thing that investors can look forward to that I didn't mention earlier was Fed rate cuts. It's May 1st. 3 consecutive days of weaker than expected labor market data. Tuesday jolts, Wednesday ADP big miss down to 62,000 headline payroll gains roughly. And then today on unemployment claims, we got continuing claims up to the highest level since November of 2021, and initial claims jumping up to 241,000, which is escaping its range of roughly 220, 215, 225. But we also got, and to your point, we got a really bad prices paid number on ISM manufacturing today. We got up almost close to 70. I think though that the low oil prices are really going to cushion the goods price pressures. I'm hoping. I think that's part of the bull case. As far as consumer spending, Ed, one thing that that I thought was huge. January and February were terrible months from a consumer spending perspective, but they really came out in March, 0.7% in real terms because inflation was zero. So 0.7% volumes, and that negated the first 2 months. Business investment, I thought was incredible, added 3.6%, albeit we didn't get a positive number because imports subtracted 5. What kind of bad economic data are we talking about here? Are you more worried about an inflationary uptick or a consumer spending retrenchment?
Yeah, I think there's a couple things to consider here. One is let's look at the consumer spending. And when you talk about consumer spending, one of the things that one of our mantras at NDR is don't count out the American consumer. If there's something we love to do, it is to spend money. And so what it really is tied to is the labor market, because for a few years, we had this cushion from COVID with the excess savings, except for the highest of income earners. That's largely spent off. And the highest income earners, they're not really worried about it anyway, because they already have some savings. So it really is dependent on the labor market. And so that's where we want to keep an eye on things, because if the labor market weakens too much, then you're going to see declining consumer spending. Are we going to see weaker consumer spending? I think we will, because you're going to see, I think you're already starting to see signs of less hiring, a little bit harder to get a job if you're looking for one. That's continuing claims. So it's going to be there to some extent, but as long as we're still adding jobs every month, then the consumer could be okay. So I think our macro team thinks there's definitely a risk of a recession, and we can talk about all the downside stuff in a minute if you want. But I think that's part of it. Now on the inflation side, we can take inflation, put it into 3 buckets. We'll take core inflation, put it in 3 buckets. You talked about energy prices, which we don't want to dismiss it. But core inflation, you've got goods, you've got housing, you got all the other stuff, which were super core. The housing part had been actually coming down, but as we get the second half of the year, our concern, before all the tariffs and everything else came into play, our concern was multifamily home prices or apartment rents really were likely to start rising next year because we're going to have a lack of supply. Because you think about 3 years to build an apartment complex. 3 years ago, the Fed was hiking aggressively. So that kind of brought that to a halt. So that would obviously bleed into single family homes too. So there's a risk there in the second half of the year. And then you get into the good side of things. And that was actually mildly deflationary. Look at the CPI for goods. It had been negative for well over a year each month. Now it's starting to turn positive. You throw on some tariffs, that's going to be positive. And so that's going to make the Fed's job a little bit harder. I think most people expect them not to do anything in May. Quite possible that they could cut 2 or 3 times later in the year. They're just going to need to get enough evidence that the inflation data this is more of a one-time shot and not something that's going to be stacking on top of each other. So that's where we go. Obviously, I look at it's not just inflation. It's not just consumer spending. It's both of them together. But I'd say keep an eye on the labor market.
One thing about the labor market is sometimes since 2017, 2018, we've had this dynamic where the job openings have been significantly above the number of unemployed folks. At the peak, we had more than 2 to 1 ratio. But the issue was that we had a mismatch. The job openings that we had couldn't be filled with the skills of the unemployed. Something tells me that dynamic still exists, and we're not going to have those kinds of upticks in unemployment that we've had pre 2008 and before that. I guess that's one reason to stay optimistic. There's just a shortage of skilled labor, it seems, and labor in general. In the NFIB survey, which is for small businesses, which make up roughly 50% of employment in America, for years, they've been complaining about labor quality and not being able to find capable workers. So I'm hoping that the labor market can stay strong, but it definitely can deteriorate as well. We've already seen a weird kind of softening in the labor market. We have the hiring rate really down. We have this dynamic where continuing claims are really elevated, but initial claims aren't. And it takes a while to get a job if you lost one or if you quit one. But if you're already in one, there's not that much pressure from an employment perspective. Apparently, not even in the federal government, according to what Elon Musk said a few days ago. Now, shifting gears a little bit, what do you think about equity sectors from here? I know one of your followers and your audience, they really like what Ed Clissold has to say about sectors and growth value kind of dynamics. Where's your head out for those kinds of concepts?
So before I get that, there's something else I wanted to kind of allude to that you hit on, which I think is where we can kind of then dovetail into sectors. So where I think the rubber is going to meet the road, if you're looking at companies' earnings reports as they come out, gross margins, I think, are going to be the focal point this cycle. The reason I say that is, what's in gross margins? Well, it's sales minus cost of goods sold. Tariffs are going to hit that harder than maybe we've seen the last few cycles. And we looked at recessions. Not saying there's going to be a recession. Let me be clear. We're going to take those increased recession risks. We're not calling for one outright, but you can use them as an example. Since the 1990s, gross margins fell a lot less than, say, pre-tax margins or even operating margins, like income before extra items. So the further down the income statement you went, the bigger the margin drop was, because there's a lot of leverage in the system. So companies felt it further down. Pre-1990, actually, the gross margins, that's where the pain was. And that's when maybe the economy was a little bit different, more manufacturing based. So if tariffs hit hard, then companies are going to say, we got to protect the gross margin. Well, what's the biggest input for gross margins? It's actually not the goods themselves, the input, the materials, even when you throw in tariffs. It's, for most companies, labor is by far the biggest part of cost of goods sold. And so that's where I think the risk is, if tariff hit margins too much, then companies are going to say, I got to cut here. And what's the best way to do it? If I can't cut input costs, I'm going to have to cut labor, which means firing. So that's where I think we got to see where the risks are. And so that's not, it's not a zero risk there. There's a very real chance that companies are still compelled to do that. So, and then get into sectors. So where we are right now is we're overweight utilities and consumer staples. So two kind of defensive sectors as we navigate through this. And ironically, up until very, very recently, even as the market rebounded from those early April lows, defensive sectors really held in there pretty well. It kind of tells you where the sentiment stood a more difficult economic environment, but also the cost structures were maybe a little bit more favorable. Healthcare is another area we have our eye on coming. Before you head into an election, if the incumbent party loses, healthcare usually underperform because it's a popular whipping boy for politicians. So you say, oh my goodness, new party in control, they're going to really shake up healthcare. Happened in 1992 when Clinton came in. Certainly through RFK Jr., there's been a lot of talk about that this time, and healthcare underperformed coming in the election. But coming out of that, after a couple months, healthcare tends to rebound because usually the bark is worse than the bite. And that's what we start to see from healthcare as well. So then the final thing I'd say here is that we're starting to see some pretty resilient earnings reports from technology. And there's been some carve outs from tech from some of the worst of the tariffs. So through maybe some political maneuvering, there may be those earnings may be in better shape. So that's another area to take a look. And the final point is energy sector. I think because of what you talked about, low oil prices could be a tough one. And Trump's been putting pressure on OPEC to increase drilling. So maybe that's not a sector to focus on at the moment.
So it sounds like you have more of a value orientation.
So officially it's neutral because we think that there's the tech possibility, but I think if you take a look at our overweights, yeah, it's more staples, utilities. That's a defensive value tilt to it for sure.
So in conclusion, Ed, what's the last thing you want to say about the state of the markets before we go?
Yeah, so I think I'd like to say, so we talked about a lot of the bonding process and positives. You were going to really get some messages over the next few months, and some of these messages are going to be pretty scary about the state of the economy, about corporate profits. There's going to be some downward revisions. So just make sure you have a long-term plan and you're sticking to that long-term plan. Now is a time for diversification and not necessarily making big bets on any one sector, one stock, because this could break a lot of different ways.
So not a time to be a hero.
Yeah, exactly. There'll be, you always want to, what do we say? The big money's made the big moves. And so there'll be a time when the trend is clear, the path is clear, and maybe that's a time to push some more chips on the table. Yeah. We'll leave the heroes for the super movies and leave the boring stuff to the investment portfolios. How about that?
Folks, that's Ed Clissold of NDR, Ned Davis Research. He is the U.S. equity strategist, chief equity strategist. Ed, we can find your research on ndr.com through Interactive Brokers as well, and a few other venues you mentioned earlier, Ed.
Yeah, so email ib@ndr.com. Also, we're on Twitter, or X, excuse me, at NDR Research. And actually, I'm on Twitter as well, at Ed Clissold.
Thanks so much for joining us, Ed. We appreciate it. That's Ed Clissold again. Folks, thanks so much for joining this episode of Interactive Brokers IBKR podcast. Don't forget to like and subscribe so that you're updated on these videos and you can receive them in your personal email. Jose Torres, Senior Economist. Bye for now. Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.